This is Reporting Matters. The Corporate Accounting Podcast starts now.
So back in 2019, there was this massive globally recognized tech company, and they reported an official audited net loss of $1.6 billion for the year.
Right, $1.5 billion just gone, up in smoke.
Exactly. But here's the crazy part. On the exact same day, they sent out this glossy, highly produced press release to the media and to investors.
Yeah.
And the CEO is enthusiastically announcing that their quote-unquote adjusted profit was actually a positive $800 million.
Which is just wild math if you think about it.
It is entirely wild. Like, how does a company magically turn a $1.6 billion crater into an $800 million mountain of success?
Well, they do it by using accounting magic, right? They simply ignore the expenses they don't like.
Yeah, they essentially draw a circle around the good numbers, crock out the bad ones, and just ask everyone to focus on their customized math.
And for decades, companies all over the world have been getting away with this.
They really have. You, as someone trying to evaluate a business, you are constantly handed this beautifully airbrushed brochure for a luxury resort.
Right.
But then you eventually find the architectural blueprints and they show a motel with a leaky roof. The gap between the story a company wants to tell you and the reality of their official accounting has always been massive.
It's arguably the defining frustration of modern financial analysis, obviously.
Yeah. But today we are looking at a brand new rule book that is about to absolutely nuke that magic out of existence.
We really are.
Yeah.
Because, you have the narrative on one side and the numbers on the other. And sitting right between them is this vast, murky ocean of creative adjustments.
Right. And we're conditioned to think of accounting as this hard science. We assume it's binary and structured and entirely objective.
But the reality is that for a very long time, the rules governing how companies present their income have been shockingly flexible.
Shockingly flexible. Management teams have had this incredible leeway to build their financial statements in a way that highlights the positive and just structurally buries the negative.
Yeah, they hide the bodies, basically.
So our mission for this deep dive is to unpack a massive tectonic shift in the corporate financial world that is designed to bridge that exact gap.
And it is a huge shift.
It is. We are diving into a dense but incredibly crucial set of source notes on a standard called IFRS 18.
Right, IFRS 18.
Yeah, it's a brand new mandate formally titled Presentation and Disclosure in Financial Statements. The International Accounting Standards Board, or the IASB, issued this back in April 2024.
And it entirely replaces the old standard, which was known as IAS 1.
Right. So we are going to decode how this new rulebook radically changes how companies are legally allowed to present their financial health to you.
And we really need to frame the stakes correctly from the outset here, because I know it is incredibly tempting to look at a phrase like IFRS 18 and just immediately tune out.
Oh, absolutely. You hear IFRS 18 and you think, oh, great, a dry routine accounting update.
Exactly. You assume only auditors and tax lawyers care about it. But that would be a fundamental misunderstanding of what is actually happening here.
Right. This is not just some minor bookkeeping tweak.
No, not at all. It doesn't alter how a company recognizes a physical asset or measures a long-term liability. Instead, it's this sweeping regulatory intervention focused entirely on presentation and corporate storytelling.
Which is what investors actually read.
Exactly. The IASB designed this specifically to fix three major long-standing complaints from global investors.
And those are?
First, the wildly inconsistent structures of income statements across different companies.
Right, the apples to oranges problem.
Yep. Second, the shady use of custom homemade performance metrics. And third, that age-old corporate habit of hiding bad news or failed projects inside giant opaque categories.
Okay, let's unpack this. Because to truly understand the impact of IFRS 18, we can't just look at the new rules in a theoretical vacuum.
No, we really have to look at the timeline.
Yeah, we have to establish exactly when this monumental shift happens. Because based on our source material, the timeline itself operates like a massive bear trap for unprepared corporate finance departments.
So it is a profound operational trap.
Right. So the source material states clearly that IFRS 18 is mandatory for annual reporting periods beginning on or after January 1st, 2027.
Right. And on the surface, if you're a CFO reading that in, say, 2024 or 2025, that sounds like a really generous runway.
Yeah, you hear the year 2027, And you naturally think, oh, there's plenty of time to figure this out. We'll hire some consultants and update the software later.
But the standard contains a specific requirement called retrospective application.
And that's the trap.
That is the trap.
Yeah.
Because of that single phrase, the year 2026 essentially becomes a ghost year. It is drafted into service as the mandatory comparative period.
I want to break down the mechanics of that because it's vital for anyone who actually reads an annual report. When you look at a company's financial statement in 2027, you never just see 2027's numbers sitting alone on the page.
Right, that wouldn't tell you anything about their trajectory.
Exactly. You always see the prior year, 2026, sitting right next to it in the adjacent column. That way you can actually judge whether the company's revenue is growing or if their margins are shrinking.
Yeah, you need the comparison.
So what does retrospective application actually demand of a company that is trying to build that 2026 column?
What's fascinating here is how retrospective application forces a corporate finance department to essentially live in two parallel realities at the exact same time.
Two parallel realities. I love that phrasing.
Well, it's true. It means that when January 1st, 2027 rolls around, a company cannot just flip a switch in their software and say, okay, starting today, we use the new IFRS 18 categories.
Right, because if they did that, their 2027 numbers would be fundamentally incomparable to their 2026 numbers.
Exactly. The main categories would be entirely different. The subtotals wouldn't match. The entire architecture of the income statement would look like two completely different languages.
And the investor reading it would be completely lost.
Totally lost. So the rule dictates that companies have to present their 2026 numbers as if IFRS 18 had been in place all along.
Wow.
Yeah, they have to meticulously recalculate, recategorize, and restate their entire 2026 financial performance under the new rules simply to provide a valid side-by-side comparison for the 2027 report.
So it's like, imagine you're planning to move into this highly organized, totally custom-built new house in 2027.
Okay.
But the movers tell you that in order to make the move, you are forced to pack every single one of your 2026 boxes using the new house's incredibly strict labeling system.
Yes, perfectly said.
You can't just throw things into a box labeled miscellaneous junk anymore. You have to open the box, look at every single item you acquired in 2026, and decide exactly which precise mandated shelf in the 2027 house it belongs on.
And you know that metaphor scales up to a terrifying degree when you apply it to a multinational corporation.
Oh, I can't even imagine.
Think about the sheer mechanical nightmare of doing that retroactively for a company with tens of thousands of daily transactions across 50 different countries.
Yeah, with all different currencies and tax jurisdictions.
Exactly. You have enterprise resource planning software like SAP or Oracle that is hard-coded to tag invoices and expenses according to the old IAS 1 rules.
Right, the software just does it automatically.
Yeah. And if company waits until the end of 2026 to try and unscramble that egg backwards, it will be impossible. The accounting teams would have to manually open millions of digital boxes to figure out where the items belong under IFRS 18.
Wait, hold on. If the retroactive process is that much of a nightmare, then 2027 isn't the real deadline at all. Companies have to be completely ready to go by day 1 of 2026, right?
Precisely.
They need their IT systems fully updated to dual tag every single transaction as it happens. Like when they pay a vendor in February of 2026, the software needs to record it under the old rule for the current year's report and simultaneously tag it under the new rule for next year's comparative report.
That is the reality of the trap. The smart companies, the well-advised ones, are treating January 1st, 2026 as the actual hard deadline.
Have to be.
They're spending millions on IT consultants right now to build that dual ledger architecture. The companies that procrastinate, assuming they have until 2027, are going to hit a wall of manual forensic accounting.
And that's going to cause chaos.
That will likely delay their earnings releases and trigger massive audit fees.
This is a vital takeaway for anyone trying to evaluate a business during this transition period. Imagine you are sitting at your desk in early 2027 looking at a company's first quarter earnings release under these new rules. You're going to be looking at restated 2026 numbers. And those restated numbers might look wildly different from what the company originally bragged about to the press during the actual year of 2026.
Oh, they absolutely will look different. The top-line revenue will likely be the same, but the profitability subtotals, the numbers that actually dictate stock prices and CEO bonuses, those might completely shift.
Because expenses have been reshuffled into stricter categories.
Exactly. It is going to be a fascinating, potentially brutal moment of truth for a lot of overhyped companies.
A forced reckoning. Which leads us perfectly into the mechanics of how those numbers are going to shift. The retrospective timeline is just the delivery mechanism.
Right, it's just the schedule.
The real meat of our source material on IFRS 18 is what it actually forces companies to change about the structural anatomy of the income statement itself. So let's dive into Pillar 1 from the source notes, which we can call the end of the income statement, Wild West.
I like that. The Wild West.
Because looking back at the old IAS, one rules the level of structural freedom that corporate management enjoyed was genuinely shocking.
It was. Under the old standard, the layout of the income statement was essentially flexible.
Right. It was driven largely by whether a company chose to present its expenses by their quote-unquote function, meaning that they grouped things into broad buckets like cost of sales or administrative expenses, or by their nature.
Meaning they listed out the actual raw materials, salaries, and depreciation.
Exactly. But beyond those basic choices, they could basically define their own subtotals. They could build the floors of the house however they wanted.
They absolutely could. The old standard IAS one was highly principles-based. It relied heavily on the good faith of management.
Which is always dangerous.
Very. It essentially said, present your financial information fairly clearly and in a way that is relevant to an understanding of your performance. But it did not provide a rigid, universally mandated template.
So no strict blueprint.
Right. And most importantly, it never strictly defined what the term operating profit actually meant.
Which is wild because you hear that term every single day on financial news.
You do. But you could have Company A and Company B operating in the exact same sector, making the exact same products, and they could publish income statements with entirely different layouts.
Give me an example of how that plays out.
Sure. Company A might decide that the cost of shutting down an underperforming factory is a normal part of business. So they include those restructuring costs above their operating profit line.
Okay, so their operating profit takes a hit.
Right. But Company B might argue that shutting down a factory is a rare, unusual event. So they push those expenses further down the page below operating profit.
Artificially making their operating profit look much healthier than Company A's.
Exactly. As an investor, trying to compare those two companies was exhausting. You were constantly trying to translate between two different, highly subjective financial dialects.
But under IFRS 18, that structural flexibility is completely eradicated. The source notes are definitive on this. All income and all expenses must be forced into 5 strict, predefined categories.
No exceptions.
No exceptions. And management can no longer make up their own main buckets. The 5 mandated categories are operating, investing, financing, income taxes, and discontinued operations.
We really need to walk through each of these because the rigid definitions change the entire game.
Let's do it. Starting with the operating category. The source defines this as the, quote, default category containing all income and expenses not assigned elsewhere, end quote. It includes a company's core business activities, regardless of whether they are integral to everyday operations or just peripheral.
The phrasing default category is the critical anchor of the entire standard.
Also,
Well, under the old system, management teams played this constant game of categorization defense. If a bizarre one-off expense hit the books, say a massive fine from a regulatory agency, or the cost of settling a class action lawsuit, management would aggressively argue that it shouldn't be counted against their operating performance.
right, they'd say, look, we are a software company. We aren't in the business of paying legal settlements, so this shouldn't drag down our core operating metrics.
Exactly. They would try to stick it in an alternative bucket down the page. IFRS 18 completely flips that logic.
It sets a trap, basically.
It establishes a negative presumption. It says, unless you could definitively prove with empirical evidence that this specific item belongs in one of the other 4 highly restricted categories, it stays in a lister. Operating.
Wow, so the burden of proof has entirely shifted onto the shoulders of management. Operating is the inescapable catch-all.
Yes. Then we move to the investing category. This is defined strictly as income or expenses from assets that generate returns largely independently of a company's other resources.
So the source provides examples like investments in joint ventures, unconsolidated subsidiaries, rental properties, and cash equivalents.
Right.
To put this in plain English, if a massive technology company happens to own a portfolio of corporate bonds, or they own an old warehouse that they rent out to a logistics firm, the interest and the rent they collect goes into this investing bucket.
Correct.
It does not get mixed into the revenue they make from selling actual technology.
The goal here is isolation. The standard wants to isolate the returns that a company is generating just by passively parking excess capital and separate them from the returns generated by the active sweating engine of their primary business.
Which makes perfect sense for an investor.
Exactly. As an analyst, you want to know how good that tech company is at designing and selling hardware. You do not want their core margins inflated just because their treasury department got lucky with real estate appreciation or bond yields.
Right. By forcing those passive returns into a distinct investing category, IFRS 18 protects the integrity of the operating numbers.
But our sources highlight a very crucial carve-out here, which is essential to mention. It's called the corporate exception.
Oh, yes, the corporate exception. The rule states that if an entity's main primary business activity actually is investing, like a mutual fund, a commercial bank, or a private equity firm, then those investing items shift back up into the main operating category.
Because if you are a bank, collecting interest on loans isn't a passive side gig. It's the fundamental core operation of your existence.
The IASB kind of had to include that exception, right?
They absolutely did.
Yeah.
The standard is incredibly rigid, but it adapts to the actual economic reality of the business model. You cannot force a commercial bank to put its loan interest in an investing bucket, because then their operating bucket would be practically empty.
Right. Their whole income statement would look absurd.
Exactly. The standard recognizes that the definition of an operation changes depending on the industry.
Moving down the structure, the third bucket is the financing category. This is exclusively for income and expenses from transactions that purely raise finance.
We are talking about the interest paid on bank loans, the cost of issuing corporate bonds, and the effects of the time value of money on liabilities like lease agreements.
Again, it is isolating how you fund the construction of the house from how you actually live in the house.
That's a great way to put it.
And then the final two categories are very straightforward administrative mappings. Income taxes, which are determined under the existing rules of IFRS 12, and discontinued operations, which map directly from the rules of IFRS 5 for when a company sells off an entire division.
Right.
By forcing literally every transaction a company makes into these 5 buckets, the source notes point out that this naturally generates 2 brand new universally mandatory subtotals on the face of the income statement.
And these new subtotals are essentially the holy grail of IFRS 18. They are what investors have been begging for.
Tell me about the first one.
The first one is operating profit or loss. As we discussed under the old rules, companies threw this term around all the time in press releases, but it was completely subjective.
It meant whatever they wanted it to mean.
Exactly. Now, it is a legally mandated subtotal defined by a strict standardized set of criteria. Every single publicly traded company using IFRS will have this exact line item.
And it will mean the exact same structural thing, whether you are looking at a mining company in Australia or a telecommunications giant in Europe.
Yes. It is simply the total sum of the newly fortified operating category.
It's the second mandatory subtotal that I find genuinely brilliant from an analytical perspective. It is placed further down the page and is called profit or loss before financing and income taxes. Why is that particular subtotal considered such a massive leap forward for investors?
It is a game changer because it gives you a purely unobstructed look at economic performance before a company's specific capital structure and tax strategies obscure the view.
Walk me through an example of how that helps an investor.
Okay, imagine 2 identical manufacturing companies. They make the exact same widgets, they have the exact same factory overhead, they pay their employees the same wages, and they sell their products for the exact same price.
So operationally, they are clones.
Operationally, they are clones. However, Company A is funded entirely by cash invested by its wealthy founders, so it carries 0 debt.
Nice for them.
Very nice. Company B, on the other hand, had to borrow heavily from a syndicate of banks to get off the ground, so it pays massive interest expenses every single month. Furthermore, Company A is headquartered in a country with a 25% corporate tax rate, while Company B is headquartered in a tax haven with a 10% rate.
Wow. Okay. So if you are just looking at the traditional bottom line net income, those 2 companies look totally different. Company A might look like a roaring success because they have no interest payments dragging them down, while Company B looks like it's barely scraping by because the bank is eating all that cash.
Exactly. But their actual widget-making businesses, their core economic engines, are performing identically.
Right.
The divergence in their final net income is entirely driven by how they chose to finance themselves and where they incorporated for tax purposes. This new mandatory subtotal profit before financing and income taxes strips away those financing decisions and tax burdens.
It levels the playing field entirely.
It does. You get to see the raw, unadulterated economic engine of the business completely isolated from the decisions the chief financial officer made in the debt markets.
It allows an investor to compare the sheer operational efficiency of two companies without the noise of leverage getting in the way.
Precisely.
But let me challenge the mechanics of this, because corporate management is endlessly creative when it comes to preserving their narratives.
Always.
If operating is now the default, inescapable catch-all category for literally everything that isn't specifically assigned elsewhere, what's stopping a CEO from just running the old playbook in reverse?
What do you mean?
Well, instead of hiding bad operating expenses down below the line, won't they just try to take their ugly, embarrassing operational costs and forcefully dump them into the investing or financing categories?
I see.
Like if a piece of factory equipment breaks down and causes a massive loss, couldn't they argue, well, we bought that machine with a bank loan, so the loss is technically a financing issue, just to make their core operating profit subtotal look artificially cleaner?
They will certainly try.
Mm-hmm.
But the standard anticipates that exact maneuver. The borders between these 5 categories are heavily reinforced by strict definitions that auditors must enforce.
So the auditor steps in.
Yes. The definition of financing is restricted to transactions that purely raise finance. You cannot sneak a broken piece of operating equipment into the financing bucket just because a loan was involved in its purchase.
Right. The financing bucket is for the interest on the loan, not the operational failure of the asset the loan purchased.
Exactly. Similarly, the investing category requires the asset to generate returns largely independently of other resources. If management tries to misclassify an operating expense to artificially boost that highly visible operating profit subtotal, the external auditors will flag it as a material violation of the standard.
Management can no longer rely on vague principles to justify their categorization. They have to meet rigid, empirical tests.
The days of structurally burying the bodies in custom-built basement categories are largely over.
Which brings us to a really fascinating collision. If companies are now forced into these incredibly strict, auditor-enforced categories on the official income statement, what happens to all the creative storytelling?
Yeah, that's the big question.
What happens to those custom homemade metrics they love to blast out in their press releases? This leads us to Pillar 2 of the source material, taming the non-GAAP beast, or the NPM revolution.
This is my favorite part of the standard.
It is wild. And to really grasp the magnitude of this shift, we need a quick level set on what we mean by GAAP versus non-GAAP and where these metrics traditionally lived.
So the term GAAP stands for Generally Accepted Accounting Principles. It broadly refers to the official, heavily regulated accounting rules, which in this context is the IFRS framework.
Right.
When a company calculates its net income according to the strict rulebook, that is a GAAP metric. But corporate management has long argued, sometimes with genuine validity, that the strict GAAP rules don't always capture the true ongoing run rate of the business.
They argue that the official rules force them to include things that obscure their underlying performance.
Right. They say things like, we had a massive one-time restructuring cost this year because we closed a division. If you look at our official GAAP net income, it looks like we had a terrible year. But if you ignore that one-time cost, our custom-adjusted profit shows our core business is actually thriving.
That is the perpetual argument. So they create non-GAAP metrics. These are customized alternative performance measures that deliberately ignore the official rules.
The most famous example is EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. It's an attempt to show pure cash profitability.
But companies take it much further than just EBITDA. They create things like adjusted EBITDA or core earnings or underlying profit.
Oh, yeah. And the problem is that these one-time cost management wants you to have a funny habit of happening every single year.
Funny how that works.
Very funny. Companies start adjusting away everything they don't like. They strip out stock-based compensation. They ignore the costs of acquiring other companies. They pretend litigation fees don't exist.
It reaches absurd levels. I mean, a few years ago, before their spectacular collapse, the co-working company WeWork actually tried to popularize a metric they called community-adjusted EBITDA.
Oh, I remember that. It was legendary.
They literally took their massive financial losses and then mathematically added back not just taxes and interest, but basic fundamental expenses like marketing administrative costs and the design costs of their buildings.
They basically created a metric that said, if you ignore all the money we spend to run our business, our business is highly profitable.
Exactly. And the wildest part is because these non-GAAP metrics lived completely outside the official audited financial statements. Like, they lived in press releases in the management discussion and analysis sections, or on flashy PowerPoint slides during earnings calls. The auditors couldn't touch them.
Right. The external auditors audit the GAAP financials. They don't audit the CEO's customized PowerPoint slides.
Exactly. The non-GAAP landscape was a regulatory blind spot, but IFRS 18 changes that dynamic entirely.
This raises an important question about accountability. The standard explicitly states that these custom metrics are being dragged from the press release directly into the audited financial statements for the very first time.
This is huge.
It is. The mechanism works like this. If management uses a custom metric in public communications outside the financial statements to communicate the entity's overall financial performance to the market, that metric officially triggers a new classification.
It becomes a management-defined performance measure, or an MPM.
Yes, an MPM. And the moment a metric qualifies as an MPM, it is subjected to an unprecedented level of regulatory sunlight.
It's like, imagine a college student bragging on social media about having a 4.0 GPA. Everyone is congratulating them. But then the university administration steps in and says, it is perfectly fine that you want to claim that 4.0 publicly.
Right.
But because you claimed it, we are now legally forcing you to attach your official sealed transcript to that social media post.
That is a perfect analogy.
Furthermore, you have to highlight exactly which failed classes you secretly decided to drop from your personal math to arrive at that 4.0, because the rules for these newly classified MPMs are incredibly rigorous. The source outlines 4 strict requirements once a metric gets pulled into the audited statements.
The requirements are designed to enforce absolute accountability. First, the MPM must be disclosed within a single dedicated note inside the audited financial statements.
So no more hiding it in footnotes.
Right. The company can no longer scatter vague references to adjusted profit across 50 pages of a PDF. It all has to live in one centralized, highly visible location that the auditors review.
Okay, what's the second requirement?
Second, management must provide a clear written explanation of exactly why they believe this specific custom measure provides useful information to an investor.
They can't just throw out an adjusted EBITDA number and assume the market accepts it. They have to intellectually justify its existence.
And the third requirement is where the forensic accounting really kicks in. The custom MPM must be reconciled directly to the most comparable IFRS-defined subtotal.
Let's walk through how that math actually looks in practice.
Okay.
If a CEO goes on an earnings call and boasts that their custom underlying profit is $100 million, but their official standard mandated operating profit is only $60 million, they have to build a mathematical bridge in that dedicated note.
The line-by-line bridge.
They have to list out exactly what makes up that $40 million difference. Like, we added back $20 million for a lawsuit, $10 million for stock compensation, and $10 million for severance packages. They have to show their work.
They have to show the mechanics of their storytelling. But it is the fourth requirement that is going to cause genuine panic in corporate boardrooms.
Oh, I bet.
For every single item that management chooses to adjust out of their metric, every step in that reconciliation bridge you just described, they must disclose the specific tax effect and the effect on non-controlling interests for that specific item.
Okay, we need to pause and unpack both of those concepts deeply, because this is where the standard gets incredibly aggressive. Let's start with the tax effect. How does the company even calculate the tax effect of something they are pretending didn't happen?
It forces a fascinating hypothetical calculation. Let's say a company took a $10 million loss on a failed product launch. Under normal official accounting, that $10 million loss reduces their overall profit, which consequently reduces the amount of corporate taxes they owe to the government.
Right, it acts as a tax shield.
Exactly. But in their press release, management says, we are ignoring that failed product. Our adjusted profit excludes that $10 million loss.
Okay.
IFRS 18 says, fine. If you want to present a fictional reality where that loss never happened, you also have to present the fictional tax bill that accompanies it.
Wow.
You have to calculate how much higher your taxes would have been if you hadn't taken that loss. You cannot claim the higher adjusted profit while implicitly keeping the benefit of the lower tax bill. You have to audit and disclose the phantom tax implications of your customized math.
That is brilliant. It stops companies from having their cake and eating it, too.
It really does.
And what about the non-controlling interests part? What does that mean in this context?
Non-controlling interest, or NCI, come into play when a parent company owns a subsidiary but doesn't own 100% of it. Let's say a massive conglomerate owns 80% of a smaller software firm, and the other 20% is owned by outside investors, the non-controlling interest.
Got it.
When the conglomerate consolidates its financial statements, it pulls in 100% of the software firm's revenue and expenses. But at the very bottom, it has to carve out that 20% slice of the profit that belongs to the outsiders.
Okay, that makes sense.
Now imagine the conglomerate decides to create an adjusted profit metric, and they decide to strip out a $5 million restructuring cost that occurred specifically inside that software subsidiary.
Right.
IFRS 18 mandates that they cannot just blindly add $5 million back to their total. They have to calculate and disclose that 20% of that adjustment, $1 million, technically belongs to the non-controlling outsiders.
It forces a level of granular mathematical accuracy that custom metrics have historically ignored.
Entirely ignored, yes.
I want to explore the behavioral economics of this for a moment, because these custom metrics, these adjusted EBITDAs and core earnings, have been the primary tools that CEOs and CFOs use to manage market expectations and, quite frankly, secure their own bonuses for decades.
Oh, absolutely. That's how they hit their targets.
Now, if they want to keep using those terms, they have to subject those numbers to a rigorous, expensive, painful audit process regarding their phantom tax effects and minority interest allocations. I'm speculating here, but won't the sheer cost and embarrassment of that process force management to abandon these metrics entirely? When the CFO realizes they have to pay an audit firm hundreds of thousands of dollars to verify the hypothetical tax effect of their customized math, won't they just throw their hands up and say it's not worth the hassle, let's just stick to the mandatory GAAP subtotals?
Or will they bite the billet, keep the metrics, and just let the audited notes section of the annual report swell to 50 pages long?
Yeah, exactly.
It is going to be a fascinating behavioral experiment. I suspect we will witness a massive initial culling of these metrics in 2026 and 2027. As companies realize the sheer operational cost and the intense auditor scrutiny required to maintain these MPMs, the really flimsy ones, the metrics that are purely designed to hide bad decisions like WeWork's community-adjusted EBITDA will quietly disappear from earnings calls.
They just won't be able to justify it.
Right. The CFO will sit down with their CEO and say, I cannot mathematically justify the tax effect of ignoring our basic inventory spoilage to the external auditor. They won't sign off on it. We have to drop the metric.
So it acts as a natural deterrent against absurdity.
It's exactly.
Yeah.
However, the custom metrics that actually do provide genuine structurally sound insight into a complex business model will survive the gauntlet. Management will pay the audit fees to keep them because investors truly value them.
But yes, the notes section of the annual report is going to become a much thicker, much more heavily debated and deeply forensic document.
Without a doubt.
Okay, so we've forced companies to use standardized buckets, and we've put their customized PR math in an audited penalty box. But that still leaves a massive loophole.
What's that?
What is stopping a CEO from just taking all their embarrassing operational mistakes? A failed marketing campaign, a disastrous IT implementation, a series of legal fines, and burying them all together inside one of those mandated buckets under a single massive opaque line item called miscellaneous expenses.
Ah, the famous other expenses line.
Right. This brings us to pillar 3 of our sources, the death of the slush fund, or what the standard formally calls enhanced aggregation and disaggregation.
This specific pillar directly targets the infamous other expenses problem. For decades, the other expenses line has been the rug that corporate management sweeps their dirt under.
Just brush it right under there.
Exactly. If you have an expense that is slightly embarrassing or indicates a failure in executive strategy, but it's not quite massive enough to trigger a dedicated separate line on the income statement, you just pull it together with 20 other minor balances and slap the label other on it.
And as an investor, you just have to guess what's in there.
A diligent investor looks at the statement, sees a massive $50 million number next to other operating expenses, and has absolutely no idea what economic reality is actually driving that cost. It is a black box.
The IFRS 18 source material outlines rigorous new guidelines designed to permanently destroy that black box. The core rule is elegantly simple but operationally devastating. Items with shared characteristics must be aggregated together, but items with distinct characteristics must be disaggregated.
You can no longer mix apples, oranges, and live hand grenades in the same basket just to hide the hand grenades.
I love that. No hiding hand grenades. Furthermore, the standard takes direct aim at companies that choose to present their operating expenses, quote, by function, end quote. We need to clarify what that means because it's a major target of the new rules.
Okay.
Presenting expenses by function means a company groups its costs based on what the money was used for in the business cycle, like creating a massive bucket called cost of sales or administrative expenses or research and development.
Right. And functional presentation is actually a very useful way to view a company at a macro level. It tells an investor how much capital the company is allocating to manufacture their physical product versus how much capital they are burning to keep the lights on at the corporate headquarters.
But the inherent danger of functional presentation is that it completely obscures the underlying nature of the expenses hiding inside those broad buckets.
Exactly. You might see that a company's cost of sales jumped by 20% year over year, but the functional label doesn't tell you why.
You don't know if cost of sales went up because global raw materials got more expensive, or because the company had to hire thousands of new factory workers, or because their automated factory equipment is breaking down and requires massive repairs.
The function hides the nature.
It is exactly like looking at a receipt at the end of a massive dinner at a restaurant, and the receipt just has a single line item that says, food $1,000.
Right.
That is presentation by function. You know what the money was used for? The function of eating. But IFRS 18 is stepping in and saying, no, a single functional line item is no longer acceptable. We need the underlying nature of the expense. You have to break that $1,000 down.
Tell the investor how much of that was the steaks, how much was the wine, and how much was the mandatory gratuity.
Exactly. Specifically, the standard mandates that if a company uses functional presentation on the face of the official income statement, they are now legally required to explicitly disclose a nature-based breakdown in the notes for 5 very specific items.
And those 5 items are critical.
Let me list the 5 targets: depreciation, amortization, employee benefits, impairment losses or reversals, and inventory write-downs or reversals.
That specific list of 5 items is not arbitrary. The IASB didn't just throw darts at a board.
Let me jump in there because I think a lot of listeners might look at that list and wonder why those specific 5 were chosen above all others. Out of all the expenses a massive multinational corporation incurs, global marketing campaigns, international travel, massive software licensing deals, raw commodities, what makes employee benefits or inventory write-downs so incredibly special that the international standard setters singled them out for mandatory, unhideable disclosure?
If we examine the mechanics of those 5 items, a very clear pattern emerges. They are heavily reliant on management's internal subjective estimates, and they often act as quiet admissions of corporate failure.
Oh, wow.
Let's take impairment losses as the prime example. Mechanically, an impairment loss occurs when a company is forced to officially admit that an asset they own is no longer worth what they paid for it or what they claim it's worth on the balance sheet.
Okay, give me a scenario.
Say a massive telecom company acquires a smaller rival for $1 billion entirely for the value of your brand name. 5 years later, they realize the brand is actually toxic and worthless. They have to record a massive impairment loss to write down that value.
Right.
Historically, a clever CFO might quietly bury that impairment loss deep inside a generic functional bucket like administrative expenses or other operating costs. They do this so investors won't easily notice that the CEO massively overpaid for a disastrous acquisition.
Ah, I see. They are using the functional bucket to hide an admission of strategic failure.
Precisely. Or consider inventory write-downs. Imagine a major fast fashion retailer produces millions of units of a terrible spring clothing collection that nobody wants to buy.
Classic mistake.
That inventory loses its economic value. They can't sell it at full price, so they have to write it down. Burying that inventory write-down inside a massive generic cost of goods sold line item completely hides the fact that their design team failed to read the market.
By forcing companies to disaggregate and explicitly list out impairments and inventory write-downs by their nature, IFRS 18 permanently strips away the camouflage.
It forces management to publicly display their mistakes in the notes for everyone to see.
And what about the mandate to disaggregate employee benefits? Why is that one of the 5?
Because human capital is typically the largest single variable cost for most modern businesses, particularly in the rapidly growing service and technology sectors.
Sure, salaries are huge.
If a company is trying to artificially inflate their short-term profits to meet Wall Street expectations, the fastest way to do it is by quietly slashing employee benefits, freezing hiring or cutting staff.
They just squeeze the workforce.
Right. An investor desperately needs to see that employee benefits number dropping to understand how the sudden burst of profit was actually achieved.
Wow. So by forcing these 5 specific items out of the shadows and demanding a nature-based breakdown, you effectively neutralize the slush fund capability of those broad functional categories.
You give the investor the exact forensic tools they need to see if the company is actually thriving organically, or if it's just cannibalizing its own workforce and writing off bad decisions to make the current quarter look acceptable.
So if we step back and look at what we've covered, we have completely rebuilt the architecture of the income statement. We've forced every transaction into strict categories, we've dragged the PR metrics into the audited notes, and we've shattered the slush funds.
It's a massive overhaul.
But as the source material points out in our final section, you cannot execute a surgical overhaul of the income statement without it bleeding into the rest of the financial reporting ecosystem.
Everything in accounting is interconnected.
Which brings us to the consequential ripple impacts on IAS 7, the standard which governs the statement of cash flows. Now, conceptually, a lot of people think cash is just cash. It's the one thing you can't fake with accounting estimates.
Which is mostly true.
But the mechanical way cash flows are calculated and presented is about to get a major upgrade to align with this new reality.
It absolutely has to be upgraded. The statement of cash flows is arguably the single most important document in the entire financial report. Because while you can manipulate profit with aggressive estimates, depreciation schedules, and accrual accounting, it is exceptionally difficult to fake actual physical cash entering or leaving the corporate bank account.
Right. Either the cash is there or it isn't.
However, the mechanical starting point for calculating that cash flow has historically been a point of massive confusion and inconsistency. The vast majority of global companies use what is called the indirect method to present their cash flows.
Okay.
And under the old rules, the indirect method usually started the math equation with the final bottom line number from the income statement, net profit.
For those who might not spend their days building financial models, the indirect method essentially works backwards. You start with the net profit number, and then you start adding back and subtracting all the non-cash items like depreciation or changes in inventory to eventually arrive at the actual hard cash the company generated from its operations.
Right. It's a massive reconciliation.
But IFRS 18 makes a highly practical structural adjustment here. The source notes dictate that under the new rules, cash flow calculations using the indirect method must start with the newly defined operating profit subtotal rather than the bottom line net profit.
Yes.
It also mandates that classification options for cash paid for interest and dividends are severely restricted to eliminate arbitrary accounting policy variations between peer companies.
If we connect this to the bigger picture, forcing the cash flow statement to start with, operating profit is a massive, elegant upgrade in financial harmonization.
How so?
Think back to our discussion about the new income statement layout. IFRS 18 mandates a pure standardized operating profit subtotal that is explicitly stripped of all the noise from investing activities, financing costs, and taxes.
Right, it's just the core engine.
By forcing the cash flow statement to start its indirect calculation at that exact same pure subtotal, the two financial statements finally speak the exact same language. You are seamlessly linking the operational economic engine on the income statement directly to the operational cash engine on the cash flow statement.
Wait, hold on. I'm not entirely buying why this is such a revolution.
Okay.
Mechanically speaking, the indirect method is just a long math equation. Whether you start at the very bottom line with net profit or you start a few lines at the page at operating profit, you are ultimately just shuffling variables, adding and subtracting to arrive at the exact same final number at the bottom of the page total cash at the bank.
That's true.
If the end result, the actual cash the company generated, is identical either way, why does changing the starting point of the math equation matter so much to a financial analyst?
It matters immensely because in advanced financial analysis, the final number is rarely the most important part of the story. The journey to the final number is where all the forensic clues regarding a company's health are hidden.
Okay, explain that journey.
If you start your cash flow calculation with bottom line net profit, your very first steps in the math equation involve backing out all the tax payments, backing out all the interest expenses from debt, backing out strange investing gains, essentially backing out all the chaotic noise that IFRS 18 just works so hard to separate on the income statement.
Oh, I see.
You are forcing the investor to mentally untangle a massive knot of financing strategy and tax policy just to figure out if the core business actually made any money.
Ah, that makes sense. You are starting the calculation with a fundamentally polluted number and forcing the investor to manually filter it themselves.
Exactly. You are making the analyst do the heavy lifting. But if the standard forces the company to start the equation with operating profit, you bypass that not entirely. You remove the noise of financing and taxes right at the top.
So it's instantly clear.
The investor immediately sees the actual pure cash generated by the widget-making operations without having to dig through complex tax reconciliations or debt interest add-backs. It is cleaner, it is faster, and it perfectly aligns the conceptual model of the business across all the reporting documents.
And what about the interest and dividends part?
Furthermore, the source notes mention restricting how companies classify interest and dividends. Under the old rules, one company might classify the interest they paid on a loan as an operating cash outflow, while a peer company classified it as a financing outflow.
It was pure chaos when trying to compare them.
Pure chaos. IFRS 18 ends those arbitrary variations. It mandates standard classifications, ensuring that when you compare the cash flow engine of company A to company B, you are finally comparing apples to apples.
So as we pull all of these complex threads together, let's look at the key summary matrix provided in the source material, because it really highlights the stark structural contrast between the old world of accounting and the new reality.
The contrast is night and day.
Under the old rulebook, IAS 1, the concept of operating profit was commonly used by management but utterly undefined. Under IFRS 18, it is a mandatory, legally defined subtotal with standardized criteria.
Right.
The overall income statement structure used to be a flexible choose-your-own-adventure. Now it is locked into 5 strict, inescapable categories.
Non-GAAP performance metrics used to live safely outside the official report in PR materials. Now they are classified as management-defined performance measures, dragged into a dedicated note, fully audited and reconciled line by line with their phantom tax effects exposed.
And other expenses, which used to operate as a dark pool for minor or mixed balances, are now severely restricted with mandatory disaggregation by nature for highly sensitive items.
And all of this goes into effect legally mandated on January 1st, 2027, with the crucial requirement that the 2026 comparatives must be restated, meaning the work has to begin right now. It represents a total paradigm shift in the mechanics of corporate transparency. It is the end of an era of bespoke financial storytelling.
So what does this all mean for you, the person listening, the person trying to make sense of the market or evaluate where to invest your capital? It means you are about to be handed X-ray vision into corporate health.
Truly.
Starting in 2027, and really starting with that vital sneak peek, when the restated 2026 numbers finally come out, the fog of war is going to lift.
Management teams will no longer be able to hide behind custom structural layouts or quietly bury their operational failures in other expenses.
Or point to a flashy, adjusted metric on an earnings call without mathematically proving exactly how they calculated it and what it means for their tax bill. The blueprints of the house are finally going to be printed clearly without the airbrushing.
But I do want to leave you with one final, slightly provocative paradox to ponder, which emerges naturally from the text we've analyzed today.
Ooh, a paradox. I love it.
IFRS 18 was clearly designed by the standard setters to rein in management's worst impulses, specifically by forcing those highly manipulated non-GAAP metrics like adjusted EBITDA inside the audited financial statements to be rigorously reconciled and exposed.
Right, to put them in the penalty box.
The intent was clearly to enforce accountability and perhaps shame companies into dropping the most egregious metrics. But by bringing them officially inside the audited document, by forcing highly respected external auditors to officially review, calculate, and sign off on the reconciliations and the tax effects, has the IASB accidentally given these previously unofficial metrics the ultimate regulatory stamp of legitimacy.
Wow. By trying to tame the PR metrics and put them in a penalty box, they might have inadvertently elevated them into becoming the new gold standard.
Exactly.
If a massive accounting firm signs off on the MPM note, it is no longer just a hollow boast in a press release. It becomes an audited, verified fact of the financial statement.
It's going to be incredibly fascinating to watch unfold in the markets.
That brings us right back to the core premise where we started. The massive gap between the glossy press release and the gritty reality of the audited statements is officially closing.
The airbrush brochure and the architectural blueprints are being forcefully bound together into the exact same document.
And the companies that have been surviving for years purely on the strength of their creative storytelling, well, they are about to face a very harsh, mathematically rigorous reality check when the numbers finally have to speak for themselves.